Folks, something big is unfolding in the gold and silver markets right now. Over the past week, we've witnessed one of the most aggressive sell offs in precious metals history. And silver, in particular, delivered the kind of move that forces you to stop, refresh your chart, and ask yourself whether what you're seeing is even real. At the same time, we're seeing some extremely unusual behavior beneath the surface. Strange coincidences, heavy accumulation, and trading patterns that feel familiar. If you've studied market history long enough, you've seen this movie before. And here's the uncomfortable truth. This kind of environment ends up creating enormous opportunities, but only for a small group of people. Most investors will look at this volatility, get shaken out emotionally, and swear off markets entirely. That's not what we do here. On this channel, our goal is to go below the surface, connect the dots, and help you understand what's actually happening so you can operate from clarity instead of fear. That's exactly what we're going to do today. So, what actually triggered a sell off this extreme? Because if you just look at the chart, it feels like a bomb went off in the metals market overnight. The catalyst was the new Federal Reserve Chair announcement. It dropped unexpectedly, forcing markets to reprice everything in real time. For months, traders were positioned for a worst case outcome: total Fed capitulation, aggressive rate cuts, unlimited money printing, and a rapid collapse in dollar confidence. That fear pushed huge money into gold and silver. Then the narrative changed. This chair pick shifted expectations from immediate dollar destruction to a more gradual one. He's still inflationary and accommodative. That's why he was chosen. But he's also seen as credible and experienced, not someone who would hand the Fed over politically. So the market said, okay, this isn't the nightmare scenario. Safe haven urgency faded, the dollar bounced, and precious metals took the hit. This was a repricing, not a rejection. This is critical to understand. The market wasn't saying gold and silver are suddenly broken, and it wasn't saying the dollar is suddenly strong. It was saying that the timing and speed of the fear trade had gotten ahead of itself. So how did prices collapse this fast? The answer is leverage. Modern financial markets are absolutely saturated with leverage. Let me give you a simple example. If you buy $10,000 worth of silver outright and silver drops 10%, you lose $1,000. It's unpleasant, but survivable. But with 10 times leverage, that same $10,000 controls $100,000 worth of silver. A 10% move doesn't hurt. It wipes you out completely. When leveraged traders get margin called, there's no decision involved. The broker liquidates the position automatically, forced selling. And when you get a sharp move lower in a highly leveraged market, it creates a cascading effect. Margin calls trigger selling, which causes more margin calls, which causes more selling. A self-reinforcing liquidation spiral. That's what destroys accounts. And that's exactly what happened here. Over-leveraging feels brilliant when prices move in your favor, but one violent move can erase years of gains instantly. And here's the key insight. Leverage-driven moves always overshoot. On the way up, borrowed money pushes prices beyond fundamentals. On the way down, forced liquidations push prices far below them. For long-term, high-conviction investors, that volatility is not a flaw, it's a feature. What history tells us? Now, let me show you something and I'll let you decide what to make of it. Right before the sell-off, the CME sharply raised margin requirements, forcing leveraged traders closer to liquidation thresholds before they could react. At the same time, several major trading platforms experienced technical disruptions during the most volatile moments. Coincidence? Maybe. Adding to that, one of the largest banks with a historically massive short position in silver reportedly covered near the exact bottom on Friday. Impeccable timing. I'm not here to tell you what to believe, but this pattern isn't new. In 1980, silver surged dramatically. Then exchanges changed the rules, restricted buying, and allowed only selling. Leverage was crushed. Silver collapsed nearly 80%. In 2011, silver ran from $18 to nearly $50. Then the CME raised margin requirements 5 times in 2 weeks. Silver was cut in half. In late 2025, silver reached new highs around $84. Margin requirements were raised again twice during thin holiday trading. Prices dropped sharply and financial media declared the bull market dead. Then recently, silver approached $120. Margin requirements jumped aggressively, systems went offline, news hit at the perfect moment, and prices collapsed more than 35%. Same mechanics, same sequence, same result. What's different this time? Here's the part that matters. The underlying thesis has never been stronger. Gold and silver are finite. You cannot create more of them. Dollars, on the other hand, are created endlessly, out of thin air. That's why over long periods of time, precious metals track the expansion of the money supply. Yes, leverage causes overshoots. Yes, prices get distorted, but those distortions create opportunities to buy panic and sell euphoria. Silver, specifically, fell harder than gold because it serves two roles. Gold is primarily monetary, a hedge, a store of value. Silver is both monetary and industrial. It's essential for military systems, medical devices, AI data centers, power infrastructure, solar panels, electronics, EVs. When the economy is strong, industrial demand supports silver. When fear rises, monetary demand supports silver. That dual role makes silver more volatile, but also gives it greater upside when both forces align. Zoom out. 6 months from now, 12 months from now, 18 months from now. There's a strong chance this moment will be remembered as a major opportunity. Will anyone time the exact bottom? Probably not. But volatility isn't the enemy. It's a toll you pay for long-term upside. 2026 is shaping up to be a year of extreme volatility precisely because leverage is higher than ever. Most people respond to that by hiding in cash. But cash comes with a guaranteed long-term loss of purchasing power. That loss flows upward to governments that inflate and to asset holders who understand how wealth transfers work. Smart money doesn't fear volatility. It uses it. What separates winners from losers isn't intelligence. It's their relationship with volatility. That wraps up today's video. Let me know your thoughts on the gold and silver crash, what you're bullish on next, and where you see opportunity forming. Thanks for watching, and I'll see you in the next one.